All right, hi everyone. Welcome to today's webinar brought to you by IronFX, where we're going to cover the live trading session. All right. All right, hi John, good to see you. All right, just want to make sure you guys can see my screen. I should show IronFX webinar series, live trading session, and just want to make sure the audio is loud and clear as well. All right, we've got the Q&A and webinar chat boxes windows open as well. So do not hesitate to drop your questions in these chat boxes as we progress through today's webinar. All right, I assume everything is all good. And okay, so before we start, let's go through the disclaimer. All right, please take note that of the risk warning, right? All the products here are traded on margin and carry a high level of risk. It is possible to lose all your capital. And also take note of the disclaimer for this webinar. Right, the information in this webinar should not be construed as investment advice or an investment recommendation, but instead just educational material only. Right, my name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, okay, before we dive into the charts and trading view, we'll just take a quick look at what's been hogging the calendars this week, right? Of course, we had the FOMC meeting overnight, so we'll do a quick review of that. We've also had inflation data out of Switzerland released earlier today, and we've got US unemployment claims coming up as well. All right, okay, so I just a slight typo here. Hang on. This should be 2nd May, right? Okay, so we've got Swiss. We had Swiss CPI data released earlier today, and we've got U.S. unemployment claims coming up in a few hours, and of course we've got the highly anticipated non-farm payrolls coming up tomorrow as well. Right. In short, it's been a pretty hectic or exciting calendar. Right, we've seen a lot of key economic events that have definitely impacted currency markets, gold prices, as well as the equities as well. Now, this is the calendar for the rest of the week, Thursday to Friday, right? So we've seen CPI data or inflation data, consumer inflation data out of Switzerland released today at 6:30 a.m. GMT. Take note, my calendar's on GMT time here. And right, okay, and so right, so you can see although inflation in Switzerland has been well anchored under the S&P's target of 2%. We can see that, however, the latest reading, I believe this April's reading, has come in higher than the forecast of 0.1%, as well as the previous month's reading. So when this is in green, right, when the result is in green, this usually means that this result could potentially function as a bullish catalyst for the Swiss franc. So later when we dive into the charts, we'll take a look at dollar franc and see how this news event has impacted the currency pair. Right, and we've also got unemployment claims coming up later today. That's at 12:30 p.m. GMT, where we've seen unemployment claims come in lower than its respective estimates over the last 3 weeks, and the current week's reading or estimate is at about 212,000. And of course, tomorrow we've got the highly anticipated non-farm payrolls, where we'll also get a look at the unemployment rate and average hourly earnings. And of course, we wrap up the week with ISM Services PMI report as well. This is also going to be closely watched, especially the prices index component of this report here. All right, as you can see here, right, the federal Fed funds rates currently stands at 5.25 to 5.5%. So after yesterday's meeting, this was the 6th meeting in a row where they held rates on hold, right? So they neither increase rates or cut rates, but because as we saw, inflation has come in hotter than expected in the first quarter of 2024, right? With both CPI and PPI data in the US coming in stronger than the estimates. Markets and policymakers are now concerned about a potential re-acceleration in inflation in the US. So should inflationary pressures do indeed return to the US in a meaningful way or in a persistent way, it's quite likely the Fed is definitely not going to cut interest rates anytime soon. Right. So let's take a quick look at the review of the FOMC statement. Of course, we are not going to go through the statement in full detail, but here are just a few points to watch out for. or to take note of. Now, as of course, as widely expected, right? Although inflation was coming in hot in the first quarter, or came in hot in the first quarter of 2024, no one expected the Fed to raise rates. However, they were, of course, going to keep rates on hold and maybe even communicate a very hawkish outlook, right? So as we all know, the Fed kept its Fed funds rate on hold at 5.25 or 5.5% for the sixth meeting in a row. Now, as I mentioned, with both US and CPI, with US CPI and PPI both coming in hot in Q1 2024, the Fed signaled fresh concerns about inflation, while indicating it was likely to keep borrowing costs elevated for longer, but also noted that recent indicators suggest economic activity has continued to expand at a solid pace. So what this is also saying that although interest rates have been kept elevated for an extended period of time, it has not severely impacted overall economic growth. So that means GDP growth as well as looking at the PMI reports, right? The PMI indicators. So looking at PMI manufacturing services, PMI manufacturing and PMI services, both by the ISM and as well as by S&P Global. Right, so the Fed is in no rush to cut rates because economic activity, the US economy is still chugging along pretty well. And of course, with inflationary pressures starting to potentially re-accelerate in the US, there's definitely no pressure on the Fed to cut rates anytime soon. And however, this is quite important to take note. The Fed is actually going to slow down the pace of its balance sheet reduction, right? So previously, the monthly reduction cap on Treasury securities was at $60 billion a month. Now this is going to be reduced to $25 billion per month. And what this means is instead of selling $60 billion of Treasuries every month, the Fed is now only going to sell $25 billion. So this means they are actually slowing down uh, the pace of QT or quantitative tightening, right? Remember, quantitative easing was when the Federal Reserve was expanding its balance sheet. That means they were buying treasuries as well as mortgage-backed securities. The opposite is the case for QT or quantitative tightening, where they are really reducing their balance sheet by selling U.S. treasuries as well as the mortgage-backed securities. Now, previously, the cap, the monthly cap on treasuries was set at $60 billion a month. Now this has been reduced to $25 billion per month. Now what this means is they're actually slowing down the pace. So that means they are not in effect tightening as sharply as they were. So you can see that this is also some form of easing as well, indirect easing by the Fed, because they're not offloading their balance sheet as quickly as they were over the last few months. All right, and the other asset that they were selling, that was agency debt and agency-backed securities. Now this cap remains unchanged at 35 billion, so no change to that. But the big one is the change of reduction cap on the treasuries from 60 billion to 25 billion. All right, and that's the statement. And then at 6:30 p.m. GMT, Chairman Jerome Powell delivered his press conference as well. So over here, during this press conference, he stated that it is unlikely that the Fed would raise interest rates in the near future, while saying FOMC officials would need to see persuasive evidence that policy is not tight enough to bring inflation back down towards its 2% target. Now, of course, they are just as they are not in a rush to cut interest rates, they are also in no hurry to raise interest rates as well. They are more than satisfied to keep the interest rate at the current levels and see how the incoming data plays out, right? So if inflation sort of tapers over the next 1 to 2 months and then it starts to trend lower again, that means keeping rates steady was the right move to do. Now, he also stopped short of signaling any rate cuts in 2024, and he also didn't indicate that rates had peaked. Now, these 2 points were something that he had mentioned at previous meetings and press conferences and were noticeably left out during yesterday's session. So overall, it was a fairly balanced statement and press conference. Okay, next coming up, looking at Swiss CPI. So this is the monthly inflation rate for headline CPI. So as I mentioned, on an annualized basis, right, on an annualized basis, inflation in Switzerland has been coming in well under 2% over the last 8 to 10 months. However, we can see that this current reading or this latest reading for the month of April came in at 0.3%, which was higher than the forecast as well as the previous month's reading. So later when we go on to the charts and trading view, we will see whether uh, this latest CPI print had a major impact on the dollar franc. Okay, up next later at 12:30 p.m. GMT today, we've got unemployment claims being released. As you can see here, over the last 3 weeks, not only have claims been trending lower, they've also been coming in lower than their respective estimates. Now, when unemployment claims are trending lower, this means that there are less people filing for unemployment benefits in the US. So in turn, this signals a robust labor market, which in turn is likely to function as a bullish catalyst for the US dollar. Conversely, as you see in a period like this in the second quarter of 2023, where we saw unemployment claims spike higher and come in higher than its estimates, this usually signals a potential softening of the U.S. labor market, which in turn then can negatively impact the dollar. However, now in the opposite scenario, right, as you can see, claims have been generally trending lower throughout at least through 2024, and especially the last 3 weeks readings, they have printed lower than the estimates, which signals a strong labor market. Now, how can we interpret today's data or today's result? As you can see here, there's a forecast of 212,000 for this week. Last week's readings was 207,000. So if the actual result comes in greater than 212,000, this means that there are more people filing for unemployment benefits. So this is typically going to function as a bearish catalyst for the US dollar. So now that in turn would mean that currency pairs like the euro, pound, Aussie, Kiwi, as well as gold prices are likely to rise. Conversely, if claims come in lower than 212,000, this means there are less people than anticipated uh, uh, filing for benefits. So this then should function as a bullish catalyst for the dollar, which of course would then mean currency pairs like the euro, pound, Aussie, Kiwi, as well as gold are likely to fall. Right. So this is how we can easily interpret the data later today. And so do keep an eye out for this news release, as it does have quite a significant short-term impact on the US dollar. Now, coming up, we have the highly anticipated non-farm payrolls tomorrow, right? So that's going to be released at 12:30 p.m., I believe, if I remember correctly. Yeah, so non-farm payrolls is tomorrow, Friday, 3rd of May. It's going to be released at 12:30 p.m. GMT. Now, coming back to NFPs, we can see that over the last 4 months, from December to March, NFPs job gains have been relatively strong. Uh, as compared to the third and fourth quarter of 2023, right? When you look at overall the first quarter of 2024, job gains have been much stronger than what we saw in the third and fourth quarter of 2023. Now, if you look at the 4-week average, it's about 280,000, right? And last week's reading or last month's reading, which was March, came in at 303,000. Okay, so for the month of April, we've got an estimate of 238,000. Now this figure is much lower than the 4-week average, which does seem to suggest a potential slowdown in the rate of hiring, right? So or in the rate of job growth. Now, should we see a figure that comes in lower than the estimate of 238,000, this is quite likely going to function as a bearish catalyst for the dollar, because not only did it miss the estimate, it is also going to come in lower than the 4-week average. Now, conversely, if we do see a data that comes in much stronger than 238,000, maybe another blowout figure like 300,000 or and above, then of course that would mean it's going to really uh, provide strong tailwinds for the dollar. But of course, uh, maybe that's not going to happen again, right? There's a reason why the estimate is at about 238,000. So many analysts are indeed expecting job growth to slow down a little bit in the month of April. So take note, should we see a miss in NFPs tomorrow, that means not only is going to be lower than 238,000, it is also going to be lower than the 4-week average of 280,000. This is quite likely going to function as a strong bearish catalyst for the dollar index. So that means currency pairs like the euro, the pound, the Aussie, and Kiwi are all likely to surge, while gold prices are likely to jump as well. All right, so take note, this is how we can interpret non-farm payrolls tomorrow as well. Okay, now let's dive onto the charts and trading view. And of course, we're going to start the analysis on the daily index, on the dollar index, sorry, on the 4-hour time frame. right? So as you can see here, let's just go on to the 1 hour time frame, or rather 30-minute time frame, to see how the dollar index traded through the FOMC statement and press conference. So the first vertical line that I have here is at 2 p.m., right? So this is when the press statement was dropped, following which 30 minutes later, as Jerome Powell started, okay, maybe this is better in the box, as Jerome Powell started his press conference, is highlighted in red. So you could see here, the dollar index actually reversed. So the statement was somewhat, or the statement I would say was inferred to be dovish by markets. As you can see, the dollar index went from trading from about 106.25, dropping to as low as 105.68, right? At 105.68. So in the first 1 hour, from 2 to 3 p.m. GMT, the dollar sold off hard. After which, as the press conference resumed, or as the press conference kicked off, we saw the dollar retrace higher. However, after which it swung wildly again before dropping all the way down, dropping as low as 105.43, right? So you can see here the FOMC statement as press conference had a huge impact and injected a lot of volatility into currency markets overnight, right? So now that we've seen that, let's start the analysis and establish the key resistance and support levels for today. Right, quite clearly, the first resistance for uh, the dollar index is going to be at this level here, right, at 106.48. This is a level where that index has run into resistance on 16th of April and of course yesterday as well. Right, so that's quite clearly the first major resistance for the dollar index on the 4 hour time frame is at 106.48. Right, I also see a pretty decent intermediate resistance level at 106.17. Right, previously this was a pullback resistance level that was in place from 26th of April till the 29th of April, right? For a period of 2 days, this was a pretty decent resistance area. However, with price cutting through it very strongly on 30th April to the upside and of course to the downside yesterday, this is not going to be the most strongest resistance level. Hence, I'm highlighting it as an intermediate resistance level here. Right, we can also run a Fibonacci retracement starting from this high on 1st of May. Oops, hang on. Where's my Fibonacci? Here we go. Starting from this high on the 1st of May down to the low of today. I believe that's a 61.8% Fibonacci retracement. There we go. That aligns pretty well with the pullback resistance here or the intermediate resistance. So you can see that this is quite likely, should we see the dollar index bounce in May, it's quite likely to stall around this level should it reach here by tomorrow. Now, with regards to support, when I look across this level here at 105.52, I see another strong overlap level here. Right, previously back on 11th of April, as the dollar index was rising sharply, it ran into resistance here at 105.52, pulled back for about half a day before finally bouncing higher. After which, what was previously a pullback resistance then proceeded to function as an support level, thus creating an overlap support. So we can see the dollar index bouncing off 105.52 on 26th of April, or 25th of April till 26th, Thursday, Friday, as well as the following week, or at the beginning of this week rather, Monday till Tuesday to bounce higher, and once again find support this morning as well. Right, so you can see very clearly. Oh, wait, UTC. So you can see very clearly that this is where a major support for the dollar index lies as well. Right, what about second support level? Now, if I want to try and identify a second support level, if this level here at 105.52 doesn't hold, that's quite likely going to be at this second overlap at 105.07. Right, so for this second overlap, we can see the dollar index running into resistance on the 1st of April, right, and after which, when it broke above this level in the second week of or in middle of April, it found strong support here on the 10th and 11th before finally bouncing higher. So this is where the second support for the dollar index lies. Now we can also run another Fibonacci retracement, this time starting from this low here on the 9th of April, going up to the high here on the 16th. Let's pull up all the fibs. Right, we can see that the 38.2% Fibonacci retracement aligns very well with the first support, and we can also see the 50% retracement aligned well with this consolidation area here that occurred on the 10th and 11th of April. So let's keep 38 and 50, and we'll get rid of the rest. Right, now, as I mentioned, we've got unemployment claims coming up. So if we do see claims coming in uh, lower than expected, right, or lower than the estimate, right, this is then quite likely going to function as a bullish catalyst for the dollar index. So that means dollar index could have a potential bounce later today. Now, should that bounce take place, just let me hang on. Okay. Now, should that bounce take place, it's quite likely it's going to push dollar index all the way up, at least towards 106 and 106.10. So that's where a major resistance level lies. So take note, if we do see unemployment claims come in lower than the forecast, then it should trigger a bullish move for the dollar index. And then we can use the intermediate resistance at the 61.8% Fibonacci retracement to help us identify a suitable take profit level. Right. So take note, a suitable take profit level for any long dollar index positions can be identified by using this intermediate resistance at 106.11 that aligns very well with the 61.8% Fibonacci retracement. Right, so I would say probably highlight it as a zone. Right, so this zone here between 106 to 110 is a suitable take profit level. Should we see a bullish catalyst for the dollar index later today? Now, conversely, because the first support is at 105 to 52. So any long positions, uh, we would use this for support to help us identify the suitable stop loss level. So since the stop loss is at 105 to 52, I would place my stop loss at about 10 to 15 pips underneath this support level. So that means my stop loss should be placed at around 105.35. So any suitable stop loss level at around 105.35 would be also, any stop loss level at around 105.35 is a suitable level to identify one for long dollar positions. Right now, what if the opposite happens now? What if claims come in much higher than anticipated? So then this is the opposite is going to happen. So that means dollar index is quite likely to fall. And should that happen, we can then use the region of the second support to help us identify a suitable take profit level for any short dollar index positions. Right. So should we see the data come in bad, meaning that we see more claims than anticipated, then we're likely to see the dollar index reverse and break through the first support to trigger a bearish breakout. And if that bearish breakout occurs, we can then use the region of the 50% Fibonacci retracement and the second support, which is the overlap support, to identify a suitable take profit level for any short positions, right? Take note of how the data is going to impact the direction of the dollar index and how we can use the respective resistance and support levels to help us identify suitable take profit areas as well as identify suitable stop loss placements. All right, okay, with that, then let's cover the dollar, move on over to the dollar franc. Remember, we had Swiss CPI data released earlier today, just a little bit earlier today, and we saw inflation rising more than anticipated in the month of March. Remember, inflation or headline CPI rose 0.3% month over month versus the estimate of 0.1%. So when that happens, when inflation comes in hot, the Swiss franc is expected to gain in strength, and when that happens, when the franc gains in strength, then that of course means dollar franc is going to fall, which is exactly what we saw. Right, so data was released at I believe 6:30 a.m. GMT time, which is this candle here, highlighted by the green dotted line. And as you can see, dollar franc, which had already been pulling back overnight, was trading at around 91.50 prior to the release of the CPI data. It promptly fell as low as 19.95. Right, it dropped easily 55 pips upon this news release. It retraced a little bit higher, but however, it does look like it's going to continue the downtrend as well. So, uh, should you have any short uh, dollar franc position that you may have just taken on, right? Then, of course, using the top of this wick here, which is at 91.33, right? Placing your stop loss at about 91.45 would be a suitable stop loss for any short uh, dollar franc positions, right? You do not wish to keep a very wide stop loss for this year, right? And then we can use this pullback support level here. You can see this is a strong pullback support level at 1997, where dollar franc has bounced off several times since the 26th of April, right? Since 26th of April, which was last Friday. You can see dollar franc bouncing off this level strongly many times. So this is a suitable area to identify uh, a stop loss, a take profit level for any short dollar franc positions, right? So take note, because we have seen uh, data come in as higher than anticipated. We saw this dollar franc sell off, and this could continue to drop lower. Now, what about resistances, right? Maybe we should identify the resistance first before trying to configure or place the stop loss. So let's do that first, right? Let's try and identify the major support and resistance levels first. So let's go back to the 4-hour time frame. And we can also see there's a pretty clear descending trend line on the dollar franc, right? After reaching a high of 92.25 on yesterday, dollar franc has reversed to drop quite sharply. We also see a pretty decent descending trend line, and at the same time, I see a strong support level at around here, right? This is what you saw earlier, 1998. This is quite clearly going to be the first major support for dollar franc. You can see since Monday, 22nd of April, dollar franc has bounced off this level several times before making a strong bounce last Monday, right? Or rather at the beginning of the week. Quite clearly now in terms of resistance, what this pullback level here at 91.71 could potentially be the first major resistance for dollar franc. And of course, this pullback resistance that occurred, or the swing high resistance that occurred on Wednesday, is going to be our second resistance. Now, what about the second support? When I look across this level here at 90.70, this looks like to be a pretty significant overlap as well, right? You can see dollar franc running to resistance here on 27th of March, after which it proceeded to function as support on the 2nd of April, and then back to resistance again on 4th of April, 5th April, then back to support again on 11th of April and the 19th as well. So you can see very clearly dollar franc has reacted off this level several times, be it as support and resistance, which is clearly telling us this is a very significant overlap support, which is what we're going to use to identify as the second support. Now, is there a Fibonacci retracement that we could use? Potentially there is one. We're going to start this retracement from here, this swing low here on 8th of March, going up to Wednesday's high. Let's see if there's any retracement levels that we can potentially use. No, I don't see anything line up. Oh, okay, I do see the 23.6%, so let's just keep that, right? Otherwise, nothing else seems to line up. All right, okay. And I can also spot another intermediate resistance level at around 91.56. You can see previously on 24th of April till the 29th of April, dollar franc failed to break above 91.55 thus creating a pullback resistance, after which it, of course, went higher at the beginning of the week. And yesterday as well, it initially found support at exactly 91.56, retracing a little bit higher before finally breaking through. So you can see this quite clearly. This was previously functioning as an overlap support, which now could be a pretty decent resistance area. It's not going to be the most strongest resistance level, hence I've identified it as an intermediate resistance, which sits at 91.56. Right. Let's see. Now let's zoom out a little bit. Right, there's one more retracement that we can use as well. This time starting from the swing high here on 1st of May, going down to today's low. All right, let's pull up all the fibs. We can see that the first resistance, which is the pullback resistance, aligns very well with the 61.8% Fibonacci retracement. And we can see that the intermediate resistance aligns well, or the 50% retracement aligns well with the intermediate resistance too. So let's keep 50 and 61, and we'll get rid of the other retracement levels. Okay, I'm just going to adjust the first resistance as well and highlight it as a zone that's bounded by the 61.8% Fibonacci retracement. Right, okay, so now these are the key levels for dollar franc on the 4-hour time frame. Right, so when looking at stochastics and RSI, we can see that at least on the 4-hour time frame, this instrument is not oversold yet, or it hasn't reached oversold conditions yet based on the 4-hour time frame for stochastic oscillator and the RSI. So perhaps there is still further downside for dollar franc, but of course, we've got unemployment claims coming up. So take note that the result of that data point is either going to cause dollar franc to continue to drop lower, or it may cause a reversal. So do watch out for that. Now, when we go down on the lower time frame, 1-hour time frame and 30-minute time frame, it does seem to indicate that dollar franc has been oversold, at least on the lower time frames. It does indicate, but that it did indicate oversold conditions. That's why we saw this retracement up higher. Now, if you're playing, decide to uh, to go short on the dollar franc because we saw inflation coming in higher than anticipated, right? I can see another intermediate resistance level here. So if you go short on dollar franc now at market, for example, right, thinking that it's going to continue its downward slide, right? Then you can see here this level at 91.35 is another potential intermediate resistance level. So we can ideally place another stop loss just above this level here. So I would not keep a very wide stop loss, so maybe a 15 pip stop loss, so that means 91.50. So because we see a pretty decent resistance zone at around 91.35, we also know that inflation came in stronger than expected in Switzerland. So there's a good chance, there's a higher probability of dollar franc continuing to drop lower here. And by identifying this intermediate resistance zone at 91.35, we can then place our stop loss at a suitable level. So by placing the stop loss at about 10 to 15 pips above this resistance zone is a good place to identify one without having a very wide stop loss as well, right? We do not want to keep unnecessarily wide stop losses, right? But because we do know there is a pretty decent intermediate resistance zone here at 91.35, just placing the stop loss above this level here, meaning about 10 pips above this level, is probably uh, uh, is just ideal, sort of ideal level to identify. And of course, we do see a strong support zone at 1998. So any short dollar franc positions, right, that you may have, you can use this first support at 1998 to identify and take profit levels. So that means we're looking at probably about a 20 to 25 pip profit. So not too bad for like an intraday scalping strategy or an intraday trade, right? So take note of that. Okay, so this is what we have for dollar franc. All right, should you have any requests for any other currency pairs or the commodities or the indices as well, do not hesitate to drop them in the Q&A box, right? Yeah, do drop your request in early so we have time to go through the analysis together, right? If not, then I'll just maybe perhaps move on over to the commodities now. Let's cover gold, oil, then we'll look at the indices, and of course, should there be any requests from from any of you. All right, okay, so now let's go on over to gold. Let's start the analysis on the 4-hour time frame. Right, when we look at the chart for gold and the dollar index, of course, if dollar index is sort of rebounding today, right, retracing higher, gold prices are likely to be falling. Remember, gold and dollar have negative relationship or negative correlation, right? So that's an inverse correlation. So that means when dollar is rising, gold prices are usually falling, and the opposite is, of course, true, right? So as you can see here, gold prices went climbed as high as $2,328 per ounce overnight. So quite clearly, the first resistance for gold or spot gold prices, which is XAU USD, is going to be at $2,324 per ounce. Now, the second resistance for gold prices would be around here. This pullback level that occurred on the 26th of April, last Friday, at $2,349 per ounce. So that's where the second resistance sits for gold. We can also run a Fibonacci retracement, this time starting from this high on the 26th of April, going down to Wednesday's low. We can see that the 61.8% Fibonacci retracement also aligns very well with our first resistance. So let's just keep that and get rid of 50. Right, now what about support? How are we going to identify any support levels, right? Well, when we look here on Tuesday, gold found good support at around $2,286 per ounce before retracing higher, right? So this is a pretty good support level. And when I look down a little bit lower, there's a stronger support level here at 2,272. You can see price sort of making like a double bottom here on the 3rd of April and the 5th of April before finally bouncing higher. So this is a pretty strong support zone for gold, which is between 2,270 and $2,285 per ounce. So take note, this is a very strong support zone for gold. Now, should you have any short gold positions, right? As you see the current 4-hour candle, it has gone from about 2,315 down to as low as 2,300, right? So should you already be shorting gold, right? You can target this first support as a potential, as a suitable take profit level, right? So anywhere between 2,285 and 2,273 is a decent level to identify as a your take profit level for any short gold positions that you may currently have. And of course, with the first resistance lining up with the 61.8% Fibonacci retracement, your stop loss should be placed slightly above the top of this wick here, right? You see the top of this wick here, just sitting slightly above the 61.8% Fibonacci retracement. So any suitable stop loss level should be placed just above $2,328 per ounce. Now, what about second support? How could we potentially identify a second support for gold? Right, I do see another decent pullback support that's occurred around here. Right, there's a small gap here that occurred on Sunday, 31st of March. Right, so this gap is still there. So this would be a potential second support level at $2,239 per ounce. Right. Okay. We can also run a Fibonacci retracement, this time starting from this low here on the 22nd of March, going up to the high on the 12th of April. We can see that where the first support sits, there's a presence of a 61.8% Fibonacci retracement, right? So that tells us that this is indeed going to be a pretty significant support zone. And let's see if there's a 78.6 that we could use as well. Maybe there is. Okay, no, probably not. That's fine. We'll just keep the 61.8. So actually, when you look at the region of the first support, this is a pretty strong zone, although it is pretty wide. Of course, this is a pretty wide support zone, but we can't ignore this overlap level as well as this Fibonacci retracement. All right, I think we can also run a Fibonacci projection, right? So the projection tool uses 3 points. So we'll start the first point from here, 26th of April, going down to point 2 on the 1st of May, and ending it on the 1st of May as well here, right? Remember the key projection levels lie at 61.8%, 78.6%, and 100%. So you can see all of them, or at least you can see the 61.8% projection aligned very well with yesterday's low or Tuesday's low. And we also see the 78.6% projection aligned very well with the pullback support at 2,272. So for now, let's just keep 61 and 78, and we'll get rid of the 100% for now. Right. So not only do we have support levels, overlap levels, pullback levels, we also have Fibonacci retracements and Fibonacci projections to add further significance to this support zone here. Right. Now, remember we talked about unemployment claims. Now, should we see claims come in higher than the estimate, then this is definitely going to add further fuel to this short gold position here. So take note, should we see claims come in higher than the forecast, we're likely to see this the bearish momentum grow for gold, and it's quite likely it's going to hit the first support. So that would be a good area to target as a take profit zone. Now, conversely, if the data, if claims come in lower than the forecast, this is quite likely. Oh wait, sorry, apologies. If the claims comes in higher than the forecast, right, then it's going to cause gold prices to climb higher. Now, for gold prices to continue to fall sharper, claims need to come in lower than the forecast. So if claims come in lower than the forecast, this means dollar is going to rise, and of course, gold prices are going to fall. So take note, for gold to continue to drop lower, we are going to need unemployment claims to come in lower than the forecast. Remember, lower claims, stronger dollar, weaker gold. So that means if that were to happen, we can then target the first support as a potential take profit zone for gold. All right, so these are the key levels that we have for spot gold on the 4-hour time frame. Is there anything else that we can look at here? Okay, no. If not, then let's go on over to oil. Right, as you can see, oil has been selling off quite sharply since the middle of April, right? It's in a pretty strong bearish trend. And it is also trading under the Ichimoku cloud. Take note, when Ichimoku cloud turns to red, from green to red, it signals a transition in trend. So we went from a strong bullish trend to a strong bearish trend. And also with price trading underneath the red Ichimoku cloud, this continues to signal strong bearish momentum as well. Right, so you can see, right, when I draw the ascending, there's a pretty decent descending trend line here as well. Right, there's a pretty decent descending trend line here. So not only do we have the presence of the Ichimoku cloud, the bearish Ichimoku cloud, we also have the presence of this descending trend line, highlighting a potential resistance zone around here. Now, with WTI, so with WTI oil bouncing off $78.60 per barrel this morning, this looks to be a pretty decent support area. It's not going to be this. It might not be the strongest support area, so hence I'm inclined to identify this as an intermediate support. Remember, I can't reference anything else in the past, right? When I zoom out a bit, I don't see any other pullback level or overlap level that I can reference. It's just one single point. So I'm not inclined to identify this as a major first support. Hence, I'm labeling it as an intermediate support. Where I do see the first major support for oil come in is going to be at $76.80 per barrel. So that's going to be the first major support for WTI oil. Right. Okay. Then what about resistances? Okay, before that, we can run a Fibonacci retracement. This time from this low here on the 11th of March, going up to the high on the 5th of April. Is there a 78.6 that we can use? Yes, we can. So we can see uh, crude oil prices, or rather WTI oil, has found strong support at exactly the 78.6% Fibonacci retracement to retrace higher. However, do take note that downward pressures for crude still remains. So any retracement to the upside is quite likely going to be a good opportunity to short oil again, right? So where I do see a pretty decent resistance area is at 79.97. Once again, this could be the first major resistance for WTI oil, right? You can see previously this level functioned as support on 15th of March, 21st of March, and you can even argue here on 27th of March as well. It functioned as support too. and of course as recently as yesterday on Wednesday too, right? So now this pullback support level has of course been broken, which now could serve as a resistance. So should we see crude oil prices retrace higher, at least coming back up maybe towards $80 per barrel, perhaps that would be another good opportunity for a short entry trade. Now, to the downside, right? If price does not reach this first resistance and reverses at current levels, this intermediate support at 78.63 could be used to identify as a potential breakout level. So we also may have a potential bearish breakout for crude oil prices. So should it reverse around current levels and start to drop lower, this retracement at 78.6%, which is $78.63 per barrel, could be used to identify as a potential breakout level. And should that breakout take place, then of course we can target the zone between here. This support zone is pretty strong. So we can target between $77.50 per barrel all the way down to $76.80 per barrel as a potential take profit zone for any short WTI oil positions that we may have. So take note, it's either we wait for WTI oil to retrace higher towards the first resistance at $80 before waiting. Look for it to stall around this level and then reverse to drop a little bit lower before identifying a short before identifying a potential short entry. Similarly, if it doesn't retrace up to the first resistance and actually reverses around the current levels, then use the 78.6% Fibonacci retracement as a potential breakout level to the downside. And should that breakout occur, then use this zone between 77.50 and 76.80 as a potential take profit zone. All right. Okay, as we approach the end of today's webinar, do you have any requests for any analysis for any of the other currency pairs or the indices? If there are no further questions, then I will just launch a poll. Truly appreciate it if you can give your feedback with regards to today's webinar, and then we'll round up the session with one more analysis. All right, just going to leave the poll running for about 30 seconds or so. I truly appreciate your feedback, and then we'll wrap up the session by going through one more analysis. Right, John, do you have any other particular requests? If not, then we'll just wrap up the session with an index, right? We'll look at the US 500 index, which US 500 instrument, which tracks the S&P 500. All right, okay. So let's wrap up the session by looking at the US 500. So for with indices, I like to start the analysis on the weekly time frame. So as you can see here, uh, the US 500 has corrected quite significantly over the last 4 weeks, right? We can see that all-time high is at 5,276. So quite clearly, that's the first major resistance. And we can also see the index has found pretty decent support at 4,957 as well. So that's where my first major support sits. And the second major support for US 500 is going to be this pullback support level here that occurred on 3rd of Jan 2022, as well as on 25th December 2023. Right, we can also run a Fibonacci retracement. A couple of retracements we can run. First is going to be from this swing low here on 23rd of October, going up to the all-time high. Let's pull up all the fibs. Right, so we can see that the 38.2% Fibonacci retracement aligns pretty well with the second support. And we can also see that the index itself did find decent support around the region of 23.6% as well. So let's just keep 23 and 38 and highlight the 38 as a zone. Right. Now there's another Fibonacci retracement that we can use as well. This time on this downtrend, starting from the all-time high, going down to the low on the week of 15 April. Right. Let's pull up all the fibs. Right. There's a pretty decent pullback resistance close to where the 61.8% Fibonacci retracement sits. So let's just tidy up this a little bit so that we can see the chart much more clearly. Sorry. And there's a pretty decent pullback resistance around here. I believe this looks a little bit better on the daily time frame. So now let's switch over to the daily time frame. Right, yep, this does look a little bit better here. As you can see quite clearly, this is a pretty decent pullback resistance. So I think while looking at the chart here on the daily time frame, I'm going to just label the all-time high as the second resistance and label the resistance at the 61.8% Fibonacci retracement as the first resistance here. Right, so we can see that back on 3rd of April till 12th of April. The US 500 found strong support here before finally breaking under. And as you can see, as it was retracing higher earlier in the week, it sort of stalled just below this pullback support here, or this pullback resistance, which also happens to align very well with the 61.8% Fibonacci retracement. Now, we can see currently US 500 is trading in within the cloud, right? When the cloud is green, it indicates strong. It still indicates strong bullish momentum, and the cloud itself, the bullish cloud itself, can help us to identify areas of support, which is what has happened since 19th of April. You can see quite clearly price finding strong support within the cloud to retrace higher. It dropped again yesterday on Tuesday. Sorry, it did find support within the cloud again and is attempting to retrace higher as well. So for now, I think at least over the next couple of days or for the rest of the week and early next week as well, US 500 is quite likely to trade between the first support and the first resistance. Right? So after a strong sell-off over the last well, strong sell-off since the beginning of April, right? Price does seem to be consolidating around the level of 5,058, or this index is consolidating around the level of 5,050, and it's quite likely this consolidation is going to continue over the next few trading days. So that means all the way till perhaps Monday or Tuesday as well, right? So take note, these are the key support and resistance levels for the US 500 on the daily time frame too. Right, okay, there's another Fibonacci retracement. Or before that, we can also see there's a pretty decent descending trend line as well, right? So although price, we can see that the cloud is offering areas of support, and at the same time, we see a descending trend line that is halting any upward movement as well. So that is why I say that it's quite likely US 500 is going to continue to trade sideways over the next few trading days, right? For the next 2 to 4 trading days. So probably all the way until Monday and Tuesday as well. Right, as I mentioned, there's one more Fibonacci retracement that we could use. Now this is going to start from here, 19th of April, going up to the high on the 29th. We can see once again the 61.8% Fibonacci retracement aligns quite close to the pretty decent pullback support level over here as well, right? So let's just zoom in a little bit. So you can see this quite clearly as well. This retracement was drawn here, 19th April up to 29th. 61.8% Fibonacci retracement is highlighting, I think it's the 50 and 61. I should say that, yeah, it's a 50 and 61, highlighting a strong support zone as well, right? So not only do you have the bullish Ichimoku cloud, you also have the retracement levels at 50 and 61.8% to help us identify a strong support zone, which is clearly you can see US 500 bouncing off this level today. Right, so take note, should you have any long US 500 positions, right? Should you have currently any long US 500 positions, take note of this descending trend line. This is an area where this index could once again stall. So identifying a suitable take profit at around 5,090 would be a pretty decent area to identify as a take profit level. All right, so that's all I have for today. All right, thanks everyone for tuning in to today's webinar brought to you by IronFX. And of course, do look out for all upcoming webinars by us as well. All right, thanks for tuning in, and I wish you all the best in your trading journey. And I'll catch all of you next week. All right, thank you.